$850 billion. That is not a statistic. That is not a policy debate. That is a financial weapon of mass destruction, and it just got activated. While you were sleeping, while you were scrolling, while you were doing everything except watching the bond market, China made a move, a quiet move, a calculated move, the kind of move that doesn't make the front page until it's too late to react. They are dumping American debt, not slowly, not cautiously, aggressively. And here's what nobody is telling you. The first casualty of this war isn't the stock market. It isn't crypto. It isn't your 401k. The first casualty is your home, the place you live, the asset you thought was safe. Your mortgage rate is about to become a weapon used against you. Your home equity is about to become collateral damage in a financial war between superpowers. And if you don't understand why, you're going to watch helplessly as it happens. Let me show you exactly how this works, because once you see it, you cannot unsee it. Most people hear China sells treasuries, and they shrug. They think it's abstract. They think it's someone else's problem. They think their fixed-rate mortgage protects them. They're wrong. And here's why. The mainstream number you see quoted is around $760 billion. That's China's official holdings of U.S. Treasury securities. Analysts cite it, news anchors repeat it, and it completely misses the bigger picture. When you add in agency debt, massive institutions like Fannie Mae and Freddie Mac, the entities that literally backstop the American mortgage market, the real exposure is closer to $850 billion. That distinction matters. That's not just government paper. That's the plumbing that makes your 30-year mortgage possible. That's the infrastructure beneath every home purchase, every refinance, every real estate transaction in America. China doesn't just own our IOUs. They own a piece of the machine that prices your home, and now they're dismantling it. The latest Treasury data shows something that should terrify anyone paying attention. Chinese holdings have been declining at the fastest pace in years. This isn't a blip. This isn't normal portfolio rebalancing. This is strategic divestment. They're getting out, and they're doing it on purpose. To understand why this matters, you need to understand the deal we had, the unspoken agreement that powered 4 decades of American prosperity. Here's how it worked. America bought cheap goods from China, electronics, furniture, clothing, everything. We got low prices. China got paid in US dollars. But here's the twist nobody talks about. China didn't just pocket those dollars. They recycled them. They took the money we paid them and loaned it right back to us by buying treasury bonds and agency debt. Think about that for a moment. We bought their products. They loaned us the money to buy more products. It was the greatest vendor financing scheme in economic history. And it benefited everyone, or so it seemed. America got low interest rates, cheap mortgages, affordable car loans, easy credit. The middle class got to live above its means without feeling the pain. China got a reliable customer and a growing economy. Their currency stayed cheap, which made their exports competitive. Their factories stayed busy. Their people stayed employed. It was symbiosis, mutual benefit, a financial marriage that worked for decades. But here's what happens when a marriage fails. The assets get divided. The debts get weaponized. And someone gets hurt. This marriage is over. The trade war wasn't just about tariffs. It was a declaration, a public announcement that the relationship was no longer mutually beneficial. When America put tariffs on Chinese goods, China heard something very specific. We don't need you anymore. But here's what America forgot. China didn't need us either, not the way we thought. They had $850 billion in leverage, $850 billion in pressure, $850 billion in ammunition, and they started using it. Look at the flows. China has been reducing exposure to U.S. assets consistently and aggressively. Not panic selling, that would crash their own holdings. Strategic selling, controlled, deliberate, maximum pressure, minimum self-harm. And it gets worse. They're not just selling, they're rotating. They're taking the proceeds and buying something else. Gold. Month after month, the People's Bank of China has been accumulating gold at a pace that's hard to ignore. They watched what happened to Russia in 2022. They watched Western governments freeze $300 billion in Russian reserves overnight. Assets that were considered safe became worthless with a keystroke. China looked at that and made a decision. They are not going to be next. Gold can't be frozen. Gold can't be sanctioned. Gold doesn't require permission from Washington. That's why they're trading paper promises for hard metal. That's why they're reducing dependence on a system America controls. Now, before I show you how this cascades into your mortgage payment, I want to mention something. If you want to learn how sophisticated investors position before these moves hit headlines, that's exactly what we cover in the Wealth Insider program. Weekly breakdowns, specific analysis, and the framework for protecting and growing wealth during market dislocations. Link in the pinned comment. Now, back to the mechanism that's about to reprice your home. Here's where most people get lost. So I'm going to make this painfully simple. The US government spends more than it collects. A lot more. Trillions more. Every single year. To cover that gap, The Treasury issues bonds. It borrows money constantly, endlessly. The debt machine never stops. In the past, there was always a buyer. Foreign governments like China bought. The Federal Reserve bought. Banks bought. Pension funds bought. Demand was reliable. But now something has changed. China is selling, not buying. The Federal Reserve is doing quantitative tightening. They're reducing their holdings, not expanding. American banks are stuffed with treasuries and sitting on massive unrealized losses. Japan has its own currency crisis to manage. The American investor, the retirement fund, the domestic saver. You become the buyer of last resort. And here's the problem with being the buyer of last resort. You get to name your price. If the government needs to borrow trillions and the usual buyers have left the room, the government has to pay more to attract new buyers. That means higher yields. That means higher interest rates. And this is where the rule you need to memorize becomes critical. In the bond market, price and yield move in opposite directions. When bond prices fall, yields rise. It's mechanical. It's automatic. It's physics. So when China dumps treasuries, bond prices fall. When bond prices fall, yields rise. When yields rise, interest rates across the entire economy rise with them. Credit card rates, car loan rates, business lending rates, and most importantly, mortgage rates. This is how a decision made in Beijing shows up in your monthly payment. Your 30-year fixed mortgage rate doesn't come from the Federal Reserve, not directly. It's priced off the 10-year Treasury yield plus a spread for risk. When the 10-year yield rises, mortgage rates rise with it. The Fed can cut short-term rates all they want. If long-term yields stay elevated, your mortgage stays expensive. This is the part that shatters the illusion of control. We're taught that the Fed runs everything, that there's a control room somewhere with levers and buttons, that grown-ups are in charge. The reality is simpler and scarier. The Fed controls the short end of the yield curve, the overnight rate. The rate banks charge each other. The market controls the long end, the 10-year, the 30-year, the rates that actually matter for your mortgage, your business loan, your car payment. And right now, the market is looking at persistent selling from China, relentless issuance from the Treasury, and a disappearing pool of natural buyers. The market is demanding compensation. The market is demanding higher yields. The Fed can talk. The bond market can refuse to listen. And when the bond market refuses, housing pays the price. Here's where it gets ugly. Higher mortgage rates don't just make houses more expensive to finance. They start a chain reaction. First, transactions slow down. Fewer people can afford to buy. Sellers have to wait longer. Prices stall. Then prices start to decline. The wealth effect reverses. Homeowners who felt rich yesterday feel poorer today. They stop spending. When spending slows, businesses cut back. Layoffs begin. Tax revenue falls. When tax revenue falls, the deficit grows. The Treasury has to issue more debt. More debt means more supply. More supply means lower prices. Lower prices mean higher yields. Higher yields mean higher mortgage rates. Do you see the loop? T feeds on itself. Each turn of the cycle makes. And that's just residential. Commercial real estate is already teetering. Office buildings with structural vacancy problems need to refinance. At today's rates, the math doesn't work. At tomorrow's rates, it's impossible. When commercial borrowers can't refinance, they default. When they default, banks take losses. When banks take losses, they tighten lending. When lending tightens, the economy slows. That's the doom loop. That's the cascade. That's what $850 billion of selling pressure can trigger. So what can the government do? They have two choices. Both are ugly. Option A, the Fed steps back in. They restart quantitative easing. They buy bonds to cap yields and stabilize the market. Call it market functioning support. Call it liquidity provision. Call it whatever you want. It's money printing, and it risks reigniting inflation. Option B, they let the market clear. They let yields rise until enough buyers show up. They accept the pain. But that pain isn't abstract. That pain is a recession. That pain is layoffs. That pain is foreclosures. That pain is a banking crisis. Heads you lose, tails you lose differently. And here's the part that makes this a war, not an accident. China knows this. They know the American middle class is tied to housing wealth. They know real estate is the engine of consumer confidence. They know that if they can force rates high enough, for long enough, they can compress American asset prices without firing a single missile. That's financial warfare. That's asymmetric pressure. That's the $850 billion weapon. We cut off their chips. They cut off our cheap credit. The difference is survivability. China can endure without high-end semiconductors for a while. America cannot endure sustained 9% mortgage rates without serious economic damage. Let me make this concrete. If you bought a home in the last 3 years with a low rate, you're locked in. That's your protection until you need to sell. In a falling market with rising rates, buyers disappear. Your home is worth what someone can afford to pay. And when financing costs double, what someone can afford drops dramatically. Your home value doesn't exist in isolation. It exists in relation to credit availability. Squeeze credit, and you squeeze values. If you're trying to buy, you're facing a different problem. Higher rates mean higher monthly payments. A house that was affordable at 3% becomes unaffordable at 8%. You either pay more, buy less, or wait. And waiting isn't free. If rates stay elevated and prices don't crash, if they just stagnate, you're not saving money, you're losing time. You're paying rent, you're watching your down payment get eroded by inflation. There's no clean path through this. So what do? First, you stop assuming someone will fix this. The Fed is constrained. The government is broke. Foreign buyers are leaving. No cavalry is coming. Second, you reduce fragility. You don't bet everything on one outcome. You don't leverage to the maximum. You keep reserves. You stay liquid enough to survive surprises. Third, you think about what's real. In a world where paper assets can be devalued, where currencies can be printed, where bonds can be dumped, what actually holds value? Things that can't be printed. Things that aren't someone else's liability. Things that have intrinsic utility. That's why gold keeps showing up in the story. Not because it's magical, because it has no counterparty risk. Because central banks around the world are accumulating it at record paces. Because in a world of financial warfare, neutral reserves matter. That's why land keeps showing up. Not speculative land, productive land. Land that produces food, resources, value regardless of what happens in bond markets.